When it comes to managing the family wealth, the jurisdiction used for the family office can affect banking access, staffing, regulation, and taxation, as well as legal structures available to the family. My name is Shiraz Vahid and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain the top 10 leading family office jurisdictions, how each one is commonly used, and which type of international families may consider using it. These jurisdictions are not presented as a strict ranking. However, the appropriate choice depends on where your family members live, where your assets are located, how your investments are managed, and how much substance you are prepared to maintain in that jurisdiction. Now, starting with the first jurisdiction on the list, that is Switzerland. Switzerland has a long established reputation in private banking, investment management, and international wealth administration. Cities such as Zurich and Geneva provides access to private banks, independent access managers, trustees, tax advisors, and experienced family office professionals. A Swiss family office may coordinate investment managers, consolidate reports from different banks, oversees family-owned companies, and manage administrative responsibilities. It may also act as the main point of contact between the family, trustees, foundations, and external advisors. Switzerland can suit families that require institutional quality banking and direct access to experienced wealth professionals. It may also be relevant when family members already live in Switzerland or have substantial European interests. However, Switzerland is not normally a low-cost option. Staffing, office costs, and professional services can be significant. Personal taxation also differs between different Swiss cantons, so the location of the family members and the office must be reviewed carefully. The Swiss office may manage the assets, but the ownership structure could still be located elsewhere. For example, a trust or a foundation in another jurisdiction may own investment companies, while the Swiss team manages the reporting and administration. Now, the next jurisdiction on the list is Singapore. Singapore has developed into one of Asia's main center for private wealth and family office activity. It offers political stability, established financial regulations, and access to regional investment opportunities. A Singapore family office may manage assets held through family investment companies or qualifying fund structures. Depending on the arrangements, tax incentive frameworks may be available, but these normally comes with requirements relating to assets under management, local expenditure, investment professionals, and business activity. Singapore is therefore more suitable when the family intends to establish a genuine operating presence. A company with only registered address will not provide the same commercial or regulatory position and advantages such as a properly staffed investment office. The jurisdiction may suit families investing across Southeast Asia, India, China, and other Asian markets. It can also be considered by entrepreneurs who have sold a business and now want to manage the proceeds through a more professional investment platform. The cost of employees, compliance, and office operations should be considered from the beginning. Singapore can provide a strong operating environment, but the family's assets must normally be large enough to justify the required substance. The third jurisdiction for establishing a family office is the United Kingdom. London has one of the deepest professional markets for international private wealth. Families can access private banks, investment managers, trustees and lawyers, as well as accountants and specialist family office employees. A UK family office may handle investment oversight, consolidated reporting, financial administration, and coordination between advisors in different jurisdictions. Some families also use London as the operational center while maintaining trusts, foundations, or holding companies outside the UK. The United Kingdom may be appropriate when the family has strong business, educational, and personal connections to the country. It can also suit families that require highly experienced professionals to manage complicated international assets. The tax position requires detailed review. The residence status of the family members, inheritance tax exposure, trust rules, and the location and management of the assets as well as control can all affect the structure. If important decisions concerning an overseas company are regularly made from London, the company may create UK tax and reporting consequences. The UK office should therefore operate within a clearly documented mandate in coordination with the directors, trustees, and administrators responsible for the wider structure. The next jurisdiction to discuss is Hong Kong. Hong Kong remains an important financial center for families connected to China and wider Asian markets. It provides access to private banks, capital markets, investment professionals, and experienced corporate service providers. A Hong Kong single-family office may manage investments held through family-owned investment holding vehicles. Certain qualifying family investment structures may also access tax concessions subject to ownership, asset management, and operational requirements. Hong Kong may suit families with operating companies, investments, or professional advisors that are already based in Greater China. Locating the family office close to the commercial source of the family's wealth can make the decisions and oversight more practical. Regulatory licensing must still be considered. An office managing the assets of one family may be treated differently from a business managing money for several unrelated families. The structure must define who owns the assets, who make investment decisions, and which activities are being carried out in Hong Kong. Clear documentation is important, particularly when the family office uses offshore trusts or holding companies. The fifth jurisdiction on the list is United Arab Emirates. The UAE has become an important family office center for families connected to Middle East, Africa, Asia, and Europe. Dubai and Abu Dhabi offers international banking, professional advisors, and access to regional investment opportunities. Within the UAE, the Dubai International Financial Center, also known as DIFC, and Abu Dhabi Global Markets, also known as ADGM, provides common law financial centers within their own legal and regulatory systems. Both centers also provide foundations, special purpose vehicle, and other structures that can support family wealth planning. A family may establish its operational office in Dubai or Abu Dhabi while using a DIFC or ADGM foundation as the ownership layer. The foundation may hold shares in investment companies, family businesses, property holding vehicles, or other assets. The family office can then manage reporting, investment oversight, and administration. Major decisions may remain with the Foundation Council, Board, and other governance body. The UAE may suit families that are relocating to region or already have businesses and investments across the Middle East. It can also provide a practical location between Asian and European markets. However, establishing a UAE entity does not automatically remove tax obligations elsewhere. The residence and domicile of family members, the location of assets, and the place where decisions are made must still be reviewed. Now, the next jurisdiction on the list is Luxembourg. Luxembourg is commonly used by European families holding investment funds, private equity interests, debt investments, and substantial corporate assets. It has an established network of fund administration, lawyers, auditors, and investment professionals. A Luxembourg family office may coordinate assets held through companies, partnerships, or investment funds. This can be useful when the family invests alongside institutional investors or want a more formal investment governance framework. Luxembourg can also support different forms of regulated and unregulated investment vehicle. The appropriate vehicle depends on the family assets, investor profile, and investment strategy. The jurisdiction may suit families with significant European investments requiring professional administration and structured reporting. It may be less practical for families with a relatively small and passive portfolio. Cost and compliance responsibilities can be substantial when it comes to setting up the Luxembourg family office. The family should therefore decide which function generally needs to be located in Luxembourg and which responsibilities can remain with advisors or offices in other jurisdictions. Now, the seventh jurisdiction is Guernsey. Guernsey has a mature private wealth industry and is widely used for trusts, foundations, private trust companies, and family investment structures. A Guernsey trust may hold investment portfolios, shares in family businesses, property companies, and other international assets. A private trust company can allow family representatives and trusted advisors to participate in trustee governance without appointing the family members as direct owners of the assets. The family office may then coordinate investments, distribution, reporting, and communication with the trustee. This separation can support continuity when the founder retires, loses capacity, or dies. Guernsey may suit internationally mobile families with assets across Europe, the Middle East, and other common law markets. Guernsey also has experienced trustees and administrators familiar with complex cross-border arrangements. However, the control of the family must be designed carefully. Retaining influence through a board, protector, or family council can be appropriate, but excessive control may weaken the independence of the trust and create tax problems in other jurisdictions. Now, the next jurisdiction is Guernsey. Guernsey offers trust, foundations, companies, and private trust company structures similar to Guernsey. It has an established fiduciary industry and a broad range of licensed trustees and administrators. A family may use Guernsey as an operational and administrative center for investment portfolios, family businesses, properties, and philanthropic assets. The family office itself may remain in another country, while Guernsey trustee or foundations provides continuity and formal governance. Guernsey can also work for families that do not want to build a large internal team. Administrative and reporting functions may be outsourced to professional providers, while the family retains strategic involvement through a board or family council. When comparing Guernsey with Guernsey, the decision should not be based only on the jurisdiction's name. The quality of the proposed trustee, the experience of the administration team, banking access, and governing documents are usually more important. The structure must also coordinate with the tax residence of the founder and the beneficiaries. A well-drafted trust does not operate separately from the tax rules applied to the people connected to it. Now, let us discuss another jurisdiction called Cayman Islands. Cayman is closely connected to international investment fund, hedge fund, and private equity industries. It can be particularly relevant for families whose wealth is heavily invested in alternative assets. A Cayman structure may include investment funds, limited partnerships, holding companies, or private trust company arrangements. These vehicles are familiar to many international banks, fund managers, and institutional investors. Cayman may suit a family office that operates like a private investment business. The family may make direct investments, participate in a co-investment, establish separate pools, or invest alongside external partners. The Cayman Islands may provide investment vehicles while the employees and senior decision makers are located in London, Singapore, Dubai, or Switzerland. This requires careful coordination. The family should document where investment decisions are made, who has the authority to act, and how Cayman entities interact with operational family office. Substance, reporting, and tax consequences must be considered in every relevant jurisdiction. An offshore vehicle should form part of a genuine commercial and governance arrangement rather than operating in isolation. Now, the last but a very important jurisdiction on the list is Mauritius. Mauritius may be relevant for families with investments across Africa, India, and parts of Asia. It has an established financial services industry and experience with international companies, trusts, foundations, and investment structures. A Mauritius family office arrangement may coordinate regional operating businesses, investment holdings, and succession planning. It can be useful when the family requires professionals who understand both African market and international financial structures. Mauritius may also be more cost efficient than centers such as Switzerland and Singapore. However, lower costs should not be the main reason for choosing the jurisdiction. The family should assess banking access, service providers' quality, substance requirements, and tax treatment of the structure. The treaty access must be reviewed based on actual activity and ownership of each entity. When asset protection is part of the planning, timing and intent remains important. Assets should be transferred as part of legitimate long-term planning before a claim or dispute becomes foreseeable. A transfer made after a liability has arisen may be challenged. Now, when it comes to the question of which jurisdiction you should choose, a family office does not need to cover every function in one jurisdiction. The operational team may be based in Singapore or Dubai, while a trust in Guernsey owns the family assets. Investment funds can be established in Luxembourg or Cayman Island, and banking relationships may be maintained in Switzerland. The structure should separate legal ownership, governance, and daily management. A trust or a foundation may own assets. A trustee, council, or board may approve major decisions. The family office can manage investments, reporting, and administration within an agreed mandate. Your residence, domicile, and citizenship remains relevant as well. The residence of the trustee, directors, beneficiaries, and investment managers can also affect taxation and reporting. The jurisdiction that you choose should support the family's real activities, provide access to right professionals, and remain practical for the next generation. A large family with complex businesses may require a fully staffed single-family office. Another family may achieve better results through an outsourced or multi-family office arrangement. The final structure should be proportionate, properly governed, and coordinated across every jurisdiction involved. So, if you would like our help in building your family wealth structure, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.